Now, as we pivot into this segment too, we want to really hone in on the Fed and what is the Fed doing. And one of the things that we've been very adamant about is that there's one more quarter point coming. We saw them just pause, which again was very much part of our base case. But because we thought a pause in September with a raise likely in November. And this is an interesting piece because you have to look at all levels of the Fed, all levels of what's happening here. So this is just looking at the estimated value of the Federal Reserve asset holdings in excess of cost, including all interest returned to the U.S. Treasury in excess of interest paid to banks on reserve balances, or the IORB. When you look at it, the bank's unrealized losses have a similar profile. To consider that over 40% of deposits are now uninsured because someone has to hold the reserves the Fed forced into the system. So again, like the problem with QE is as long as you're buying all of these bonds, you're putting a mark on it. But the moment you stop and interest rates go up, well, all of your holdings are going to inherently lose value. And that was what we've been talking about. And this is for those that have known me since 2008 or before. My whole view was you can do QE in spurts. I'm by no means saying you can't. We've seen how it can work, but you have to pull back. And this is what we've described it as a bow and arrow, where if you keep using the bow with never tightening the string, eventually the arrow is not going to go anywhere. And then it'll actually just drop and fall straight into your foot. And even though you were trying to do something with it, it went nowhere. It actually injured you. And that's where we sit right now. It's injuring us. And for people out there that think the Fed has to lower rates, there's nothing they can do, there is something they can do. And the answer is keep rates elevated. And I know it doesn't make sense, or for some it doesn't make sense because if you do that, things are going to break. It's like, yes, things are supposed to break. That's what's supposed to happen. You can't have this level of inflation, this level of liquidity, pulling it out of the system and expecting things not to break. Somebody was asking about, what about states going bankrupt? Yes, maybe they should go bankrupt. Maybe there needs to be restructuring because people need to do due diligence. If you don't do due diligence, you're at fault. If a pension fund doesn't do due diligence on the bonds they're buying, they're at fault. They're going to take a haircut. It happens. We are in a country that has one of, if not the most robust bankruptcy system out there for this reason. The goal is go bankrupt. If it's not a viable entity, Chapter 7. If it's a viable entity, Chapter 11. And you'll get flush with cash. You'll get new cash injections. You'll trust management. You'll sell off pieces. The whole point of the process is to reinvigorate the system. You have an efficient use of capital. If a company is inefficient at using capital, you get back whatever you can and you redeploy it into the system. As somebody who has been long Argentinian debt and other, what was my boss's fame? What was his comment? He was like, "Oh, do you know when somebody's gonna give Argentina money again?" And again, I was a baby at the time, and I was like, "No, is it gonna take some time?" He's like, "The day they declare bankruptcy is the same day somebody will lend them money." And it's true. It's like everyone thinks that there's going to be this huge issue, this huge problem. It's not going to happen. And we need to clean the system. We need to purge the system. So given that this is just the top piece right here, given that interest has already been remitted, they estimate that the Federal Reserve is actually insolvent in an amount close to $2.4 trillion. So they can print money for that $2.4 trillion. And that's the inherent problem, because it's like, well, what is QT? Is this QT a bigger issue? Is this a bigger problem? And that's going to be an interesting thing to watch, because they have to keep rates higher, but you also don't want to shock the system. It has to, just like it was a gradual increase. Obviously, there was a massive spike in 2020. Then there was a hard pullback, and then you kind of settle out. And that's going to be the balancing act that has to be walked, is in terms of that balancing piece of without shocking the system. Unrealized gains on investment securities gives you an idea of kind of where things are. So typically, excuse me, this is looking at the FDIC insured institutions. There is an unrealized loss. And that is going to be a continuous problem because you have banks that have taken foolish risk. And they had duration risk. They got sloppy. The Fed never, for some reason, they never tested banks for rate hikes or rate increases. They only tested for, when they did these stress tests. And one of the things that we've been saying for those that have been following us, I wrote an article. It came out in February of 2021, and it was the Fed has lost control of rates. And it was that the yield was going to force the Fed's hand. And that's why when you look at if they were to cut rates, you would just send inflation back up. And that's what they don't want to see, which is what we're going to look at when we compare some of these current moves to what happened in the 70s and in other areas. And that's why it's not surprising when you look at the current level in 2023, there is another rate hike that is expected to come. If you look at the Taylor rule and then you use your R adjustments, and the Taylor rule is just looking at where the Fed funds rate should be. So if you do some R adjustments, we should be at about 6.25. And what Powell's going to say is, I won't get us to 6.25 because that's when things can break that we may not be prepared for. Instead, he's going to get us to that set 5.75% and then hold firm. And the whole thing is, I could get us higher. I could push us there, but I'm not going to because that's dangerous. But when you look at the dot projections, you continue to see this expectation of things staying elevated, and that's what we have to see. That's how you clean house and start to have people do due diligence again, focus on cash return and cash flow positive nature, cash on cash returns, instead of this esoteric, sometime in the distant future I'll make money. Well, no, now you're getting this more normal, I guess you could say, or a reverting back to the mean in terms of how we look at investments. So when you look at the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms, not surprising to see that the banks are tightening lending standards at levels that have always resulted in a recession. And again, these are the same things that have to happen. You have to see this pullback because we had extremes. You had money going into all of these cryptocurrencies. And again, I'm not saying that some cryptocurrencies aren't 100% viable and will exist 50 years from now, but there's a lot of junk out there. Just like in the dot-com bubble, everyone had a dot-com. Then, there's still some of those that are still around. You have to weed out the weak. And this is how you do it by, again, putting the pressure down, who can actually survive and who can manage under the current regime. I should say under the current rate regime. We estimate the estimate impact of monetary tightening on real GDP. You can see again, you're pulling liquidity out. You're increasing the tightness. You're decreasing flows, which is going to have a slowing factor. Our view is that if you want to say that that bell curve kind of moved to the right, and it's going to last longer than what people expect. And that's our view, is that as the consumer struggles and really pulls back, that we're not going to have this massive hard landing. It's going to be a soft landing that just won't go away. And that's that stickiness that we continue to see, which is why when you look at the US GDP forecast, you have this view of this big bump, and it's just realistically, it's going to be a struggle. It's going to be this very pitiful growth, if you will. And that's where I think we're going to continue to see some of these sticking points. But yet equity analysts are assuming global activity is going to bounce higher. Equity analysts are assuming a rebound in business activity, but this, again, when you look at bond yields, you look at mortgage rates, you look at student loan payments picking back up, a potential government shutdown, where? Like, on what are we going to see a bounce? And that's the biggest concern, because when you look at, and this is an interesting one, looking at the 40s, the 70s, and 2020s, when you look at the problems, and that's why we talk about the 70s, and it's followed it fairly closely. And this was the thing, is they started to see inflation come down in the 70s, and they started cutting rates. And then you saw this reacceleration. And our point is they want to avoid the reacceleration. Now, what Saudi is doing with pushing us closer to $100 oil, things are going to break faster and harder because of that. But it's also going to be a driver for inflation, and that's this crux, or the problem that we're in, is there's still so much liquidity out. Yes, liquidity, or whether you want to use M0 to M3, is negative, but you have to look at how positive it was, and even if you start to take things out, we still have a lot of money in the RRP that has to come out. We still have other programs out there that need to be drained, because if you cut rates too soon, again, you're just going to see that liquidity unlock, and that you're going to see another pickup in inflation to a degree that they don't want, because we've already seen a pickup in inflation as rates are going up. And there's a lot that goes into inflation, but the problem is there's been so much currency printed over this time period of the last, let's call it, 18 years, that it's going to take time for it to come out. And that's again the struggle, which is why that global economic revival is not something that we see. Instead, when you look at global PMIs, it's what we're saying. We're going to get to this 47 to 48, which is in contraction, and then just kind of flatline there. And that's going to be the struggle. It's like we're not really dropping like a rock, but we're also not growing. And that's, I think, some of these bigger issues. Now, capital markets are expecting that economic pickup. And that's where it's like, when you look at the ISM manufacturing side, to those that have been following us, we've been saying manufacturing was going to bounce. It got to 46, 47, but it was going to bounce back to 48, 48 and a half. The issue with services is that you're going to see services come down and fall into contraction. But again, services in consumers aren't going to go to the 30s and be in the steep contraction. It was going to be that 47, 48, likely maybe even 49, and just have that kind of that meandering growth. So there's a view that the capital markets tend to move with or even lead the leading economic indicators. But look at where the leading economic indicator is and where these different bond ratios are, the domestic cycles versus defensive. It's been sideways. And the reason why is because there's so much liquidity out there. Yes, it's been reduced, but there's still so much that you have to put it somewhere, and it's finding its way into the equity markets. Core capital goods shipments continue to outpace new orders, which is typically consistent with slowdowns. The spread not yet deep enough to be consistent with recessions, but it's consistent enough to be negative and problematic. And that's where it's like we don't see a deep, massive drop. And that's the difference this time around, is when you start looking at some of the capital goods, the core goods in general, it's not going to be this huge rollover, but instead this frustrating, if you will, kind of, lackadaisical movement. And the problem is, and again, for anybody that has watched this, we've been saying from the beginning, we never understood buying mortgage-backed securities. We already had low rates. You already had low mortgages. Why were they buying MBS? And our view was that they were overstimulating the housing market, and they were going to break something. And our view was they were going to break the pricing metric. And in order to get in front of that pricing metric, they were going to have to keep rates very elevated for a very long period of time, because the only way this chart on the left rectifies itself without home prices coming down is wages gapping up. And that's where, when you look at what home prices are doing and that bounce back up, and this is what we've been saying, is that home prices were going to bounce higher before we get the crack. The crack is coming. That is not, it's not a matter of if, it's a matter of when. And it's just because you're going to have that shift, because labor can't afford what is currently happening right now. And that's where we're going to see some of those different pieces. In which range is the most likely starting quarter of the next recession. You can see it keeps getting pushed out, 2025, and a lot of that is because of that let's just say that kind of pivot in general, this movement over. And I think that's a much bigger issue when you look at the impacts of the Fed. So some of these issues started slower, but I think they're going to gain traction faster. So we do see the problem still hitting in 24, not really bleeding into 25. Now, when you start looking at, again, some of those shifts, so as RRP volumes come down, well, you can go into treasuries. And that's where you're getting actually a more normal market. Now, as somebody who worked in the overnight market, who traded in, at this point, I was in middle office operations supporting the guys that were trading, because I was a baby at the time. Excuse me. You could see it's like, well, if instead of parking money in the RRP or the reserve ratio program in terms of the reserve program at the Fed and make nominal basis points, well, I can go into the paper market and make 3%. So I have options. I don't have to park money at the Fed RRP. I can go into the treasury markets. I can go into the paper markets. And that's more normal. We need to see that, which is why as these balances come down, you do have a natural buyer of treasuries. And that's why one of the things where, as much as I still think there's probably some more upside to the 10-year and to rates, you're going to start to see that kind of level off. And that's the positive nature of having, again, being the reserve currency and having that treasury market, so it won't get out of control. There will be a certain amount of control wrapped into it. The developed world employment and orders backlog, when you look at employment and the backlogs of work, you can see that there's, again, that slowing down piece, that struggle overall, and the percentage of countries with PMI below 50, you're seeing that pressure. We're going to see, again, that trend down in just global growth, which, again, ties us back to the first segment where, world employment and orders backlog are moving the same direction. You still have net negative growth, which is going to be that pressure point. And then the estimated chance of the Fed rate hike is still lower, but we do think it's going to continue to rise. Now, when you start looking at the U.S. 10-year Treasury yields, the yields have surpassed another milestone above 4.6%, first time since October of 2007, on track for the largest monthly move in the past 12 months. Now, when you start looking at how that impacts it, then the effective interest rates on capital, non-capital spending plans, well, they get reduced. Already pulled back at current interest rates. Don't finance spending through borrowing. Excuse me, that's what we're seeing more of. CFOs are pulling back because why am I going to stress my balance sheet given where things are? And again, that results in more slowdowns, more pressure on the economy, but then keeps people going into tips, which are just inflation adjusted yields. And that's why we're going to continue to see those yields move higher, because we're seeing, again, trends moving up. CFO's survey optimism index improved a bit, but again, it's just, it couldn't get much worse, but it's not going to get much better. Again, it's just kind of finding that balancing point in terms of where things are. Then when we look at, again, back to work, where we had a little bit of an increase, which typically happens as we head back into the fall months, end of summer. But as you can see, we're still averaging about around 50% activity. And as we've been saying, we don't see that improving much more. So that's what we have for you on the Fed front on this side. In the next segment, we're going to go deeper into the savings and some of those leading economic indicators, and more importantly, also the real estate market.